So the cool thing about having ETFs in a super fund is that they don't have to ask themselves like, what the hell is balanced? Because all the super funds will vary on these things slightly, or you're going to have to read the PDS because you're not 100% sure. So I think there's something really cool about taking known products. It doesn't have to be ETFs. It could be any kind of known product in market. Because ETFs in a way are like the commoditization of diversified investing. There's lots of platforms out there that are like, we're a managed fund. Yeah, but now I have to figure out what exactly you're managing. Whereas I just know what VAS is. For me personally, that was kind of a more intriguing thing that, got me interested in that different type of super fund. Less about the tax drag element and just more like I understand what the hell I'm investing in because I've been investing in it outside of super for 5 years. The Aussie Fire podcast is a collaboration between Strong Money Australia and Pearler, Australia's favourite boring long-term investing platform. Join our hosts, Dave from Strong Money Australia and Hayden from Pearler, as they discuss all things financial independence. At Aussie Fire, we're big fans of sharing experiences and talking about money. However, please note that any advice is general and does not consider your financial situation, needs, or objectives. Consider whether it's appropriate for you and, if in doubt, speak to a licensed financial advisor.
G'day everyone, welcome back to the Aussie Fire podcast. So today in this episode, we're going to be speaking about super, and specifically we're going to be talking about what Hayden and myself have done with our super since we started working. So we're going to be digging back into the history of our super, sort of how we approached it from the very beginning all the way through to today. And we're going to be talking about how we choose to invest our super and why we've chosen that particular strategy. But before we get into that, Hayden, you were recently telling me something that I think other people might find quite interesting, and it was somewhat of a phone hack, let's call it. Do you want to share with everyone what you recently did and the savings, let's say, that you were able to make?
Yeah, for sure. I needed a new phone for work because my current phone was getting a little bit old, and I noticed on the Telstra website that they were doing a deal with a Pixel 9 Pro where it was half price, I think down to $950, but they were saying that if you traded in your old phone, you would get a $600 credit essentially towards the new phone. So it was like, okay, well, that's great. Your $950 phone gets reduced to $350 essentially. But the problem I had was my phone had a crack in it, and they basically don't take phones in that have cracks. They won't trade it in. So I ended up buying a brand new $300 phone and trading it in for about $250 about an hour later to get the $600 of credit, which basically meant that was like $550 saved off the $950 phone. And because it's a work phone, it's essentially it's a tax deduction because it's a device for work. So that obviously took off another, 30-40% of the value, whatever it is. So I ended up getting a $1,600 retail price phone basically for like a couple $100, $250, which was pretty cool.
That's pretty damn good, really.
Yeah, it's exciting.
Had you been noticing these credits before and you're like, okay, next time I need a phone, I'm gonna look at that? Or did it just happen sort of accidentally?
Yeah, I mean, I have friends, we share deals with each other all the time, and we shoot stuff across. I mean, I think this stuff happens sometimes because I think it's from the perspective of Telstra, I imagine that they think if someone trades in their phone and they get the credit, that they're probably going to stay a Telstra customer. And most people probably are, like a lot of people that particularly will shop with Telstra will sign up to plans and things like this and stay with them, right? Because I obviously chose to buy the phone outright, but the phone was obviously way cheaper in a per month cost if you signed yourself up to a plan. So yeah, I mean, that's how it works. I mean, this is true for most businesses, right? There's always a small skerrick of people at the bottom that don't do deals how they want people to do them. But yeah, no, just random stuff.
I suppose when you enter anything where there's like a credit involved or the company's offering a credit, I think a lot of times people just mentally factor that into what they can afford to spend either on the phone or the plan itself. So they'll end up, spending more than they otherwise would. Do you think that's probably fair to say?
Yeah. I mean, I think it does just depend on, I mean, they're loss leading with the credit, right? Because they'll think they'll make it up with the phone credit or whatever you call it, the phone plan or something like
plans,
that. Yeah, exactly.
Or what I mean is people will go for a higher model phone because of the credit that's coming, right? So they'd actually get a more expensive phone than they would otherwise.
Yeah, assuming they're making more margin on the bigger phones for sure. Yeah, businesses think of all kinds of crazy things. But enough about my scheming plans, Dave. I mean, we were chatting briefly before the podcast and you were telling me about that you had some pretty exciting news that you published a book that no one's reading, right?
Yeah. So, I published a book probably a little bit after this podcast comes out, right? Because this podcast is recorded in late November. So I published a new book in mid-November. And it's this one. So the first book, most people probably have read it or listened to it. They're listening to this. But that was essentially how to get to financial independence. And the second book is essentially what to do once you're, halfway along, maybe 3/4, maybe fully financially independent, and you're not really, super sure about what to do next, or you're a bit worried about kind of transitioning away from full-time work. Because I've noticed that a lot of people, when they are in a position when they can afford to work less, they find it fairly scary and they're not exactly sure what a new life looks like because they're not really, in contact with anyone who's actually doing that. And so there's a lot of different anxieties and things that come up there. So it's essentially about giving people like a blueprint of what it looks like to step away from work or even reduce work when you can afford to, figure out kind of what lifestyle you want, things like that. And then essentially how to get over all those mental hurdles and actually enjoy your freedom and also let yourself enjoy your money as well and the wealth that you've built, because that can be a bit of a worry for someone as well. And people feel a little bit scared about that after saving and investing for a long period of time.
Do you think it'll be as successful as your first book?
It's very hard to say because I think it naturally applies to less people, because if you think about the people that are coming into like the FIRE movement or financial independence, like the first book is essentially like all of the beginning sort of principles and foundations of how to do it. But then only obviously a smaller percentage of those people will get to financial independence because some people will give up or it'll take a long time or all the rest of it. So I think it'll naturally apply to less people, but it could also equally apply to people like founders or business owners who are like exiting a business and they find themselves who are in their 30s or 40s with a fair chunk of money, and then they're not really sure what to do in that situation because it is fairly unusual, or they find themselves with an inheritance and in a situation where they don't necessarily have to work and they're way before traditional retirement age. So it probably could apply to a lot of people outside the FIRE movement. But in this little community, I do think it'll naturally be probably read by less people, unless those people are genuinely curious because it's coming up in the next 5 years or so of their life and they're wanting to know a bit more about what to do.
Would you write this book if you didn't get paid for it?
Yes, because I have no idea, because I don't know of a book that exists specifically for this purpose, for this audience, for this kind of age group. So I have no idea what to base it on. So I have to I spent essentially almost 2 years writing the book and I have no idea how it's going to do, right? So it's kind of one of those things where I happily accept that this just might not be popular or it might not be profitable or something because I had to spend time and money to produce the book. So I really don't know, but I am happy with how it come out and I think there's some very valuable messages in there that should help people. So that's all I can do. That the rest is up to everyone else. So whether they enjoy it or not, and then share it and whatever with their friends and people who might get value from it. So I just go into it accepting that I have no control over the outcome and that's okay. I'm fine with that.
Well, that's awesome. Love that. Good luck. I guess when this podcast comes out, if people want to buy Dave's book or read about it on the internet from a pirated version, I'm sure that there's ways to consume it.
Yeah, most people are probably going to end up listening to it, and they're listening to audio right now. So most people end up, I think with books these days, it's fairly common to use like your Spotify, your monthly allowance for your Spotify hours, your credits there, or your Audible credit. So it kind of feels free to a lot of people. So I think that drives quite a few listens, which is good. So however people want to listen to it or get it, that's fine. But enough about that, mate. Let's get on with today's episode, and it's all about super, right? So let's go back to the very beginning and tell me, when did you first start earning super? Did you get your first sort of job that paid super when you were still in your mid-teens, or was it not until a fair bit later? Like, when was your first super experience?
I think I was 19. I think I was at university. I think I did a lot of cash jobs in high school, or frankly, I did a lot of sole trading. I taught myself how to program and I was making $300 here, $500 there. When I say here or there, I mean like that happened 6 months apart. Like I wasn't swimming in the cash. I was making like $1,000 or $1,500 a year, basically doing sole trading work as a software developer. So yeah, I didn't really come across super at all. I was invoicing people and trying to, get this money coming in. And yeah, it wasn't until uni when I got an actual proper like casual job and a super account got opened. And Yeah, I don't think I really looked at it for probably 2 or 3 years at least. I wasn't really interested in it at all, right? As a lot of young people are.
Yeah.
What about you?
So I started earning super. My first job was at Big W when I was I just turned 15 or something like that. So I've been earning super since then. And from memory, Big W's default super was with Rest. So I had a Rest fund from the beginning. I think it was, and they obviously put you in like a Rest balanced fund, I think it was. And then from there, I worked there for a few years, and then I came to Perth and I got my first full-time job, and that was labouring in a factory. And that super fund that they put me into was, I think it was CBUS. It was like the building industry fund essentially. But I was paying very little attention to it, and I knew I had two super funds, right? I did what most people do, whereas you just go to your new workplace and you just get whatever fund they give you. You're like, okay, that's fine. I have no idea what's going on. So that was my kind of initial experiences with super and which funds I had at the start.
Yeah, okay, that's interesting. Did you also get signed up for life insurance like me and not realize it for a few years?
Yeah, because you just get, I think it's default to get, I don't know if you get life insurance and the permanent disability insurance. I'm not sure if they do that by default under the same umbrella from memory. I'm not sure if you remember that either. It's been a very long time since I've opened a new sort of industry super fund or anything like that. So I don't actually remember. But I ended up, once I started taking more interest in finance and money in general, then I looked into super, and then I'm like, okay, well, the first thing I should do is probably combine these funds into one. So I think I looked at the fees, and the Rest one was cheaper than the CBUS one. So I switched my CBUS fund into Rest. I rolled it over. So then I had one fund. So that was my first super optimization, I guess you could say, switching from 2 to 1. And then I think not long after that, I thought, well, I've got a fairly long time horizon, right? So maybe I'll switch it from balanced or whatever that default fund is. It's usually balanced. Let me switch that to high growth, because surely that's probably going to be better over 40 years, because I would have been like, I don't know, 18 at the time. That's going to be better for over 40, 45 years than balanced, surely. So that was my first strategy change as well. So that was pretty early. With your first super, did you pay much attention to, or when was the first time you kind of looked at the fees, or you looked at how it's invested and things like that? Was that pretty early, or did that come later?
I never really looked at the fees, because working at the university as like a casual staff member, I was doing everything from, teaching, like qualified work, all the way through to literally one job I had was like an 8-hour day, one-off casual job where I was just licking envelopes to shut them, to like mail off to high school kids. So it was a whole range of work, but
that explains a few things actually.
Yeah. The what are the microplastics in my body?
You spent 8 hours a day licking glue.
It's way less fun than you think. Well, actually, I guess probably exactly as not fun as you'd expect. But I pretty much wasn't that engaged because you couldn't change your super fund at the university. Like it was always going to get paid into a certain super fund, and that meant I wasn't really interested in fees or whatever, because that was kind of moot. At first, I got interested in the life insurance because I noticed money leaving the account, to cover the premiums. So I turned that off because I was like, what the hell would the life insurance be for? I'm just like a 22-year-old kid. Later on, probably around about the time I started Perla in 2018, so it would have been about 25 then. That's when I kind of got intrigued, like you did with the balance fund, and I changed it from balance to high growth as well. I think a couple of years later, I added in about 20%. Instead of 100% high growth, I made it like 80% high growth and 20% emerging markets. I don't know why. It must have just been a Tuesday night where I was feeling a little inspired about the developing world or whatever. Yeah, exactly.
Yeah.
And I was like, yeah, let's do that. And I just changed it like that. And it pretty much stayed that way for the next 5 or 6 years until 2025, to be totally honest.
Wow. Okay. So that was a fairly consistent strategy then for quite a long time until relatively recently.
Yeah. And I think, with uni super as well, they were generally well regarded. So it was like, okay, I'm in a high growth option. The emerging markets was performing about the same. Best to leave it alone, right? Like don't go and touch it too many times. So I wasn't too concerned about it. I only really reviewed that approach when I ended up moving my super to Perla, as you'd expect, right? Like it's the company I started. So naturally, if we had launched a product in superannuation, I was going to move my money there. I think I was the first account in Perla Super because I was testing it, right? Like we're building it. So obviously it kind of stayed that way until that changed and it was pretty much just high growth the whole way. Did you stick with high growth the whole way through, or did you start poking around different funds? You strike me as the type of person who definitely got more engaged over time.
What makes you say that?
I feel like you slowly like to learn things and eventually have like a strong view on something. So you're not the type of person that like, I can imagine being like read about stuff for one day and then changed your fund, but I can picture you being in high growth and then reading and learning and then one day being like, this is my new right strategy.
Yeah, that's fairly accurate actually as a personality assessment. I do things very slowly, but then once I decide something, I
slowly but surely, Dave.
Yeah, something like that. So yeah, my scenario is maybe a little bit more unusual or perhaps a bit more interesting for some people, where I was in the high growth rest fund from probably 2007, let's say, until 2015. And so what changed in 2015 was essentially when I started investing in shares specifically. Before that was just property. And as a lot of people do, when they start investing in shares, they think, hey, I can do this. Like, I can pick my own stocks. Surely I can figure out what a good company is and what a crap company is and make better returns than average. And so I was doing that in my personal account. So I had a personal portfolio where I was picking shares as a relative beginner. And so I thought, well, why don't I just do this with my super as well? Because I can have some control over it if I want. And so I found this super fund that was with ING, where they were basically, it's like a member's choice option, right? Where they let you have control over where your money is invested into things that are listed on the ASX. And you have to pay generally more fees for that because it's like a higher control account and you have to pay brokerage with each of the transactions and all that, which was fine. I thought, that's okay. I don't mind paying, slightly higher fees because it's kind of fun. I get to control which companies my money's invested in, and it's going to be like a fun experiment. And I suppose if it doesn't really work out that well, it doesn't matter too much, because at that point I'm thinking I'm probably not going to be reliant on this money, because this was like 2015 where I was not too far away from being financially independent. So I thought, not that much can go wrong, surely. So I essentially started picking stocks inside my super fund and did that for perhaps, I want to say 2 years. And then what I essentially learned was, and outside my super fund as well, in my personal portfolio, I'm like, some of these stocks are doing really well, some aren't doing that well, and some are just kind of okay. Like, some are crap, some are great, and some are just in the middle. And then I'm like looking at the market returns, and then I'm looking at things like LICs, where there's just a basket of companies. I'm like, and I had this account with ShareSite, obviously, where I'm tracking my performance, and then I'm comparing it. I'm like, I'm kind of doing all this, and if anything, I'm like slightly behind. And then I'm like, what's the point of this? I'm like researching the companies, I'm reading the reports, I'm doing all this stuff. And then I'm like, wait, there's people who do this for a living, and I can get these funds for a low fee if it was like a certain LIC, or I can get an index fund, which is just the biggest basket you can get, for a very low fee as well. And then I basically don't have to do anything. So I started thinking, well, this isn't really working out like I hoped. Maybe I'll just take a more hands-off approach and let other people do it, or just buy the whole basket. And then I don't have to worry about it, right? It's going to save me a whole bunch of time. So at that point, and I think that was roughly 2017, could have been 2018, I switched from the ING Members Choice to what was then called Sun Super, which is now effectively Australian Retirement Trust, because they kind of merged with another fund and rebranded themselves. So that's what I did then. And at that point, I changed the strategy from stock picking and essentially went with the Sun Super funds, and I just chose international indexed shares, because in my personal portfolio at the time, it was basically all Aussie shares, because I was focused on dividend income at the time to live off. So I thought, well, let me kind of balance that and have all international in my super fund. So that was what I did.
That's really interesting, a journey. And when you say international, like, maybe this is before you thought about ETFs a lot, but what happened was, once I started getting exposed to ETFs and I was choosing investment options within my super fund, I would often think of them in my head as particular ETFs. Like, I would think, oh, what is international index? And I'd be like, that's kind of like VGS, I guess. Or, Aussie shares as like VAS. Did you do that kind of equivalency with ETFs in your head as well?
Yeah, I did, because at that exact time, I was also learning about index funds and things. And I'm like, okay, well exactly. I'm like, okay, well if it's international shares, that's going to be the same as VGS because that's international shares index.
Did you use that to compare performance at all? Like, did you look at that and say, oh, VAS is performing 11% per annum and the specific super funds performance of their Australian shares is 10.5%. I wonder what the difference is.
No, I didn't get down that rabbit hole initially where you can look at performance discrepancies. It was mostly a choice based on strategy at the time, like I said, of just diversifying a bit more. Like, hey, let me just have international shares in my super, and the lowest cost and most diversified option is international index. So let me just pick that. That kind of makes the most sense to me as I was learning more about broad diversification and low costs and things like that. So that was around that sort of time frame as well.
Yeah, cool. That's really interesting. And I guess, had you started to develop a want for super funds just to let you buy ETFs out of curiosity? I only asked this because obviously, like, I've launched a product that does a similar thing and we've talked to customers about it before, but was that a desire you felt, being like, I just wish I could put money into VAS or VGS directly in my super fund?
That's a good question. I would say no, because I essentially thought that they were exactly the same thing. So I thought, so that thought essentially never entered my head because I thought, what's the same thing, right? I'm getting an international index fund here, or I could just buy it in my personal name. Or if they gave me the option to invest in VGS, I thought, well, that's the same, right? So we just unpack that a little bit, I suppose. I suppose that desire to buy ETFs in my super came a bit later when I learned about the tax treatment of super, and that then prompted me to eventually end up switching my super to Perla for a couple of reasons. So I actually wrote an article about this if someone wants to see the full sort of breakdown and the numbers and things like that behind it.
Before you dig into that too, I think it's worth, we seem to have enough listeners now that I want to just quickly share, like, obviously Dave uses Perla Super now, and obviously I started this company called Perla, and obviously we're on a podcast that's sponsored by Perla. So there's obviously that like shill-like vibe.
Yes.
That,
I'm
comes
sure.
up. I think it's worth flagging, like, when we were designing Perla Super, we talked to lots of different people. Dave's obviously someone who has a lot of authority in the community. He writes books. People listen to him. That means we think Dave knows some stuff. So when we're thinking about what a Perla Super product is, we talk to Dave and be like, do you like this? Do you not like this? And he probably weighs into, if I had to guess, 10% of the decision-making we can control. Just him personally, and a couple of other fairly important people do as well. Once we launched Perla Super, like, Dave was pretty upfront too, and being like, I'm not interested in moving my funds over at this point because there's still these problems I have with it. Or, I haven't quite found the comfort I want in it. And I think that's worth raising because it's not a case of like Dave uses Perla Super because people pay him to. It's actually a case of like, we kind of build something that we want Dave to like because we think Dave does things that other people do, or vice versa. And then also Dave doesn't really do stuff if he's not happy. And he's pretty vocal about that because he's a self-funded retiree. So he doesn't really give a damn about what companies think. And even last night I got quite a heated message from him about something to do with the app, as much as Dave gets heated. So I think that's just worth flagging because obviously otherwise I'm just thinking about if I was listening to you have a conversation now about why you moved to Perla Super, it would just feel very like, yeah. So continue otherwise.
Yeah, no, it's true. It's good to point that out. But I'm not going to put my money somewhere where I'm not genuinely happy and where I wouldn't do it anyway for valid reasons, which otherwise it's just like stupid, obviously, isn't it? It doesn't make sense. I'm going to put my own personal investment decisions before I put any like relationship that I have or don't have with a company. That just doesn't that's what makes the most sense to me. So if we unpack why I've essentially wanted to have a more control over my super again. And the reason for that is partly for tax reasons, because I suppose let's just unpack it. Super is essentially taxed a bit differently to how your normal ETFs in your personal name are taxed. And so everyone will think, yeah, well, super's better because you get taxed at 15% instead of 37 or 45 or 30 or something like that. And that's true, but the catch to that is it's taxed at 15%, but not on the income of your fund. It's actually taxed at 15% on the entire return of your fund. So to account for future capital gains tax and people moving out of the fund later in life, like retirees who are able to sell down tax-free and things like that, your super fund essentially, I think we might have covered this before, but your super fund essentially harvests away some of the capital gains each year from your super return. So instead of the return being like, say 10% for a year, it will end up being like 9%. Where the super fund has essentially harvested away 10 or 15% of the returns, because they do pay, I think it's 10% long-term capital gains tax rate in super instead of 15% on the income. So there is some, slight discrepancy there. And you can find this because when you look at the returns, which you mentioned earlier, Hayden, of super funds that break down the returns from their accumulation accounts and from their retiree or their pension or whatever they call them, I think they call them mostly pension accounts or accumulation accounts. And so if you look at the returns on both of those for exactly the same strategy within the fund, you'll find that the returns differ by quite a bit each year, like often by about 1% per annum. And the reason for that is the tax that I'm mentioning, the tax that gets essentially harvested away. And that's just the nature of how the funds operate. They're trying to set aside funds for future capital gains liabilities as such.
If I could just unpack that as, again, a bit of a novice with this, it's like, obviously, Dave's trying to say it's like, okay, well, you lose performance every year because you're essentially paying the tax of old people is like one really reductive way to think about it. But the flip side of that is when Dave in that fund becomes an old person, he's not going to pay as much tax either because all the young people are going to offset that for him, right? Like the circle of life continues. But I'm imagining, Dave, that, the feeling you have with that is like, it's like that simple idea of, if you were trying to invest and you got charged 10% on the way in and 10% on the way out, that's generally going to be worse than getting charged 0% on the way in and 20% on the way out, broadly speaking, because you want as much principal in there compounding from the start, right? Like, so it's not that you're like, there's a way to avoid tax. It's like the way they just tax stuff is more front loaded, and there's a feeling you have that hurts over the longer term because I've got less that's growing every year and compounding, right? Is that fair?
Yeah, that's pretty much true. I think just to add to that, it's not necessarily only retirees that benefit from that. It's essentially anyone who changes their strategy in their super at any time for any reason.
Yeah, because if you go from balance to high growth, they got to sell stuff and that incurs capital gains tax a lot of the time.
Yeah, exactly. So this is why you can switch strategies every week if you want to and not incur any tax, because the tax has already been harvested away, if that makes sense. If you've noticed, if anyone's done this at home, you'll notice that there's no like tax that gets taken away. So yeah, it's worth mentioning that.
So that was bugging you, basically.
Yeah. So I thought, well, that's like less than ideal. So one of the options that you can utilize to work around that is if you have a self-managed super fund, where you have full control over what you're investing in, and you essentially want a scenario where your account is taxed individually instead of as a big, broad group as like a super fund, right? Because they basically pool all the money together. They're called pooled funds, and then they'll tax that whole fund regardless of whether you've transacted or not, whether you've sold or not, you're still getting that capital gains tax harvested away. So essentially you just want to be treated, your super account treated individually. That would be ideal. And the way you could do that is with a self-managed super fund or with one of these like members choice type options that I mentioned earlier, where I started out picking stocks, and if I sold a stock and I'd made a profit, then I would pay capital gains tax. Or when I got a dividend come in, they would take away money for income tax. So I was getting treated individually on that account. It didn't matter what everyone else was doing inside that super fund or what stocks they owned or whatever. My account was separate to everyone else. So I liked that treatment. That is, as you said, that's kind of ideal for long-term compounding, because if you don't want to sell and you have like a 30-year strategy or more, then there's none of that, little amounts harvested away all the time. You can compound for longer. And then essentially when you get to retirement phase, you can enter retirement phase, which is tax-free, and then you never have to pay that capital gains tax because you've never sold. So that's like the ideal solution, and you can do that in a few different ways. And so one of the ways that you can do that is with the members' choice accounts. And that's essentially what I think Australian Super's got it. There's a couple of others that have it. Perla has it now. And so I switched to Perla, but the tax actually wasn't the main reason, even though it was the initial prompt for me looking at switching accounts again. It was essentially because on the Perla Super options, I noticed that there was geared ETFs that were allowed to be invested in. And I thought, actually, that's kind of interesting because this money is money that I'm not going to touch for the next, say, 30 years. I'm not going to be selling it. I can add to it if I want to kind of improve the outcome over the long term. And it's not money that I'm going to or it's not funds that I'm going to panic sell because I can't access it anyway. So there would be no point in selling, no advantage to selling. So I thought that's kind of interesting. Let me look at what the options are and the ETFs that were on offer. I'm like, okay, they look all right. I would actually choose those if I wanted gearing. So I kind of put a bunch of these together because there was 3 or 4 or 5. I had to work within the limits, the stupid limits of what you have on the Pearl app mate for safety. And I was able to make a geared portfolio essentially I think it's 98% geared because there's a 2% cash amount that needs to be held. So that's essentially where my super has ended up now. And I'm pretty happy with that as a long-term strategy. So I wrote a full article explaining why that is, the numbers behind it, the thinking behind it, the long-term strategy, and the potential payoff that I expect to get from it. And also carefully highlighting that it's definitely not for everyone. It's only for people that meet 3 or 4 or 5 important criteria, which I kind of just mentioned. But yeah, maybe we'll put the article in the show notes because then it's if someone is wanting to know a bit more about the thinking behind it because they think I sound a bit crazy, then the article will explain exactly all of that sort of underpinning behind it.
So 2 things on that quickly. Firstly, for the listeners who are maybe for the first time hearing about geared ETFs, we did an episode on geared ETFs in episode 38 where we talked about them. And then in episode 49, we talked about them in relation to super. Secondly, this is a case where Dave is trying to be very nice sounding to the Pearl Super Fund, but we didn't actually have these geared ETFs there when we launched, and Dave told us in no uncertain terms that he's not interested in it unless there was geared ETFs because he didn't see a reason to move for his personal circumstances without that, which I think is a better story and a truer story. Dave's very polite. And I think that makes a lot of sense, Dave, that the kind of gearingness would intrigue you, as well as some of the tax drag elements. And I think just to replay that again, so it's if I look at Pearl Super and I compare it to another super fund, yeah, you're not having to pay rebalancing tax or old people selling out things tax. But the downside, so to speak, is that let's say, you've built up a massive amount of, IVV, S&P 500, and it's $2 million and now it's time to retire. And this thing is low dividends, so you got to start selling it down. Just like you would if it was outside of super, as you sell that down, you will, your super fund will have to withhold tax, that 15% or whatever it is, and then take that away. But the theory, of course, being that that's okay because the amount of money, even after the 15% you're taxed, in theory, would be larger than if you'd kind of taken that tax drag hit along the way. That's the theory as far as I understand Dave's approach with stuff. I'm probably not as meticulous as Dave. I don't lose sleep over that. I think he's right, but it's quite heady for me. I actually have this thing. I do a lot of talking about super, and one of my favorite things about now investing in super, because I now invest in ETFs in super, right? Whereas a year ago I was just invested in high growth or whatever it was. One of my favorite things about ETFs is, and I describe it in the webinar as, if anyone's ever been overseas, I know Dave's been to Thailand, we've both been to Thailand, and you go into a grocery store in Thailand, there's just all this kind of stuff on the shelf and you don't know what any of it is. And it's to make sense of what it is, you have to read it. Yeah.
Everything's interesting. You're like, what's this? Yeah.
You got to see what the ingredients are, understand the value proposition of this. And what I like about the idea of ETFs and super, and obviously I'm biased because we built the product for it, but is that you know what an ETF is? I tell people it's if you shopped at Woolworths your whole life, it's really easy to shop at Coles because it's the same Barilla pasta, it's the same Mount Franklin water. So the cool thing about having ETFs in a super fund is that when I've been chatting to customers who sign up to it, like they don't have to ask themselves like what the hell is balanced, and not just what the hell is balanced, but what the hell do you think balanced is super fund, and what's your strategy? And because all the super funds will vary on these things slightly, or you're going to have to read the PDS because you're not 100% sure. So I think there's something really cool about taking known products. It doesn't have to be ETFs. It could be any kind of known product in market, because ETFs in a way are like the commoditization of diversified investing. There's lots of platforms out there that are like, we're a managed fund. But some people are just like, yeah, but now I have to figure out what exactly you're managing. Whereas I just know what VAS is. This kind of concentration on products like, Vanguard and BetaShares ETF. So for me personally, that was kind of a more intriguing thing that, got me interested in that different type of super fund. Less about the tax drag element and just more like I understand what the hell I'm investing in because I've been investing in it outside of super for 5 years.
So would you say it's more of the absolute transparency and control maybe because that exact ETF? Because you invest in that exact ETF in your personal account. Is that the appeal?
Yeah, and it's kind of cool too. And I understand this now because I'm obviously a user of super as a consumer, but I'm also like someone who has a company with a super fund. And it's really cool having a super fund company, I guess, because our one, because they users pick the ETFs. So there's no investment management fees and stuff. And I sound like I'm trying to sell it, but I'm really just trying to explain it. That's really cool because we're like totally not in the market of like having to decide what the right fee is to manage a balanced portfolio. We're just like, not our problem. That's your problem, And
like having to manage a strategy for someone. You're just like, okay, here it is. There's an admin fee and you can pick
that's
what
not
you
our
like,
business.
more or less.
Like our business is to allow people to buy ETFs and super. But again, I don't want to keep rambling about that because it will just sound like I'm trying to sell it. But this isn't really related to, I guess, ETFs or not ETFs and super. But during the process of going from like a major super fund to an ETF-based super fund, one thing I did start to think more about, as you were kind of talking about, was the tax differences in super. Because we've kind of talked about this in previous episodes, Dave, where, growth versus income investing and stuff like this. And it only occurred to me really this year that I'd been gravitating away from ASX equities and ASX ETFs because of the higher marginal tax rate that I have these days. Whereas I think super is really interesting, and I kind of wish I thought about this more before I started investing or, put the money in initially, is, hey, maybe VAS is less scary than IBV when it comes to super proportionally, because one of them is not suddenly getting, a 37, 45% marginal tax bracket. It's just getting the 15%. So I think there's definitely an element where it's like anyone who's been influenced by tax rates and tax losses based on income versus growth ETFs, that gap is reduced in super, as far as I understand it at least. And I wish I think I'd thought of that before I started picking the ETFs in my last, my current super fund.
All right, so just before we get into, because I actually want to know what ETFs you've chosen, and I'll share what I've chosen, because I don't think we've actually shared that with each other. So that'll be interesting to unpack and why we've chosen those specifically. But before that, I feel like I should say something negative now about Pearl Super because you've been...
Good, because I've got another one coming too. So let's both do a negative one.
So the admin fee is too high. You need to get that down. You need to cap it at like a certain balance, and that would help a lot because it is fairly expensive. And it almost becomes cheaper at some point to get a self-managed super fund, which it shouldn't really, because that's way more complex and way more sort of regulatory hoops for the individual to jump through on that. So the fee needs to come down or it needs to be capped. Yeah, and then we'll get on to... So what's your negative? And then we'll get on to the specific ETFs because I think that'd be more interesting.
Let me share two negatives, but let me also talk about your negative because I think your negative's not that bad. Well, let me elaborate. So the current... At the time we're recording this in November of 2025, the admin fee for Pearl Super, we publish it as 0.438, I think, %. And I hate saying things recorded because I'm always like, was it 0.39%? I think it's 0.38%. 0.438% currently. Check the PDS is the correct answer to any questions about fees. And that is a higher fee than a typical super fund because a lot of super funds have a cap. So basically you pay a percentage fee until you hit like an upper limit, and then the dollar amount doesn't go up even if your super fund balance gets bigger. Pearl Super's percentage fee is actually not that high. It's just there's no cap. So for very small balances, it's actually like not crazy. It's pretty reasonable. But for large balances, and including my balance, my personal balance of like a couple $100,000, it's quite high compared to some other super funds. Now, to some extent, that's made up by the fact that if you've chosen pretty cheap ETFs, the overall fee isn't as high, but like a customer's not joining a super fund with ETFs to then be like, oh, that's fine. I'll just like cancel out my savings that I made in a high admin fee.
Yeah.
The high admin fee though is a nearly solved topic. It's not something I sort out myself. It's something that, you know, my co-founder sorts out, and I'm CC'd in a ton of emails, and it's imminently being solved. It's something that we couldn't launch with for a whole bunch of boring, legalistic, business-oriented, commercial kind of reasons. But that one's being imminently solved, because from day one we've been like, this is a problem that, you know, it's going to be a problem for people. And like, I don't like it. Like, I don't get Pearl Super for free.
Yeah.
You know, I think I'm about break even compared to my old super fund, but I'm like, why are my admin fees so high? It still comes out of my retirement, right? But I actually think the two genuine problems that would affect people that aren't going to be solved imminently, one is insurance. You know, because of the nature of that fund, because it's not a pooled fund like you talked about, it's actually a little bit more difficult to get insurance sorted. And that one we are working through because the fund doesn't have insurance with it. But it's a bit of a slower process to solve that problem. So we know that, you know, for people who like life insurance is a big part of their super fund choice, they're not going to be interested in the product. And fair enough, you know, that makes sense. The second problem, which isn't really a problem, but you mentioned earlier about, people can change their investment options really willy-nilly in a normal super fund. In these kinds of non-pooled super funds like Pearl Super, I think the downside is that there is a penalty for learning in that type of super fund, if that makes sense.
You have too much control. You can tinker.
We'll talk about it in a moment when we talk about what's in our portfolio, but basically I chose some ETFs in my super fund and then they went up. And then I've been thinking about changing it.
Naughty.
I feel, well, it's different because now if I was to sell an ETF and buy a different ETF or rebalance it into a different type of portfolio, there is going to be an immediate tax effect that hits. You know,
which
because
then
I'm like
almost defeats the purpose of having an individually taxed account, right?
Yeah, I mean, basically, it's like if you're someone who wants to change your super portfolio yearly, I genuinely don't know. I'd have to think about it mathematically, but like, surely it can't be. Surely you'd want to basically shift your tax burden onto like the broader pool of people in the super fund.
Yeah, 100%. If you're in a situation where you are someone who, for whatever reason, wants to be very tactical and very, I don't know, sort of on the move with your super and your strategy, and you do want to essentially tweak it quite aggressively every 2 or 3 years, let's say you move like large portion to cash, or you go to property, or you go to high growth, balance, whatever, and you're kind of hopping around. And although that's probably not a good idea, let's just say that's what you want to do. Then you are going to be much better off in a pooled account where the tax is already kind of harvested away versus the individual account, I would say, because you're going to get the low fees and you're not going to be worse off for the tax because you're going to cop the tax if you were taxed individually anyway.
Yeah, exactly. So I think they're like the two big. The admin fee will be sorted out. I mean, this will be released 2 months from when we're recording it. I'm hoping it'll be sorted out by the time people are listening, and if not, it'll be shortly after that. But yeah, the life insurance, and if you're quite an active super fund portfolio changer, are I think the two big like things to consider that make a product like where we have our super right now for different reasons. Like maybe not, maybe it's not for you. Which I think is good, by the way. Like I actually, when people don't sign up to any product I make because it's not right for them, I'm just thrilled, to be honest. I'm like, makes your life easier, makes my life easier. So if you need life insurance, stay the hell away from the stuff I built at the moment. Check back in late 26, maybe.
All right, so let's unpack now what's in our super portfolio since we are investing in ETFs. I want to know from you, what's your portfolio look like and why does it look like that?
The vast majority of my superannuation is held up in about 75% IVV and 25% VAS.
Okay. What's the maximum you're allowed on IVV, by the way?
I think it's 75%.
Okay, you maxed it out. Yeah, okay.
I think so. It's around about that. I did it once when I transferred it. Now, I think I regret that a little bit because I'm feeling a little exposed to the US market at the moment.
Okay, yeah.
Maybe when this podcast comes out, like the US AI bubble will have popped and people will be laughing. But I think again, I'm like, well, hey, if dividends are only taxed at 15% instead of the marginal tax rate, I think VAS is a lot more interesting to me in super. So it was 75-25. In hindsight, I think I probably just really would have gone more 50-50 personally. And that's a pretty baseless thing. I don't think about these things too much. I don't think I'm very smart with it. But ever since Dave basically started emailing us on like a fortnightly basis, being like, you guys, the super fund sucks without geared ETFs, it got me thinking about geared ETFs more. So as of, I think a couple months ago, probably when we did the episode on geared ETFs and super, I was like, yeah, this Dave guy seems to be making some sense. So I basically changed the super fund to do, I think it's for all new contributions. I think it's about 50-50 between GHHF, which is geared DHHF, and geared GNDQ. Yeah, it's about a 2-to-1 ratio. So call it like 33% NDQ and 66% GHHF. Now, to be clear, I think like a leveraged NDQ, a leveraged NASDAQ 100 is a marginally irresponsible decision to some degree. It's like quite focused.
Volatile.
Yeah, but also the thing was, because I didn't want to sell, I didn't want to rebalance the rest of the portfolio. And we don't add money to super that quickly, right? Like we just don't, because it's this portion of our income. I haven't been too fussed about it because if I'm being pretty transparent, I've had this here for months and months now. And like, I have like $5,000 in GHHF and like $4,000 in GNDQ from like contributions that have come in like all year kind of thing. So yeah, it's also an element of like, I'm not too fussed how it goes because I wasn't changing my whole portfolio in that direction. And I mean, it's nice to sit with it for a little while. So basically the short answer is I think I'm pretty 50-50 broadly on Australia, US. I think I'm just trying to figure out what my steady state portfolio is for the long term and whether I want to sell stuff. And I think I want to get more into geared stuff because I think Dave was pretty convincing on that. And maybe over time I'll try and shift things across and just take the tax hit. But largely, I mean, I don't stress about it too much because IVV, VAS, geared DHHF or geared NDQ, I mean, it's not like they're not bad options, right? Like a lot of these broad-based ETFs are all going to be fine in one way, shape or form. But that's pretty much my portfolio as it is currently. I think as saying that out loud, it makes me sound significantly more chaotic and less thought out when it comes to this stuff than I think in my head I thought I was. But I'd be curious, Dave, to hear maybe your slightly more calculated and calm approach to these things.
Yeah, so mine is because I was able to essentially start fresh with whatever I rolled over from Australian Retirement Trust. So I built the portfolio from scratch and I haven't touched it since. So it's effectively, I had to work within the limits of obviously what's allowed in each ETF, which is like I suppose based on a risk rating and things like that. And I wanted to get the portfolio to 100% geared, right? I wanted to have all geared ETFs. So I would actually prefer to just have one geared ETF and that would be GHHF. But that's not allowed because the limit is, I think it's 40% is the maximum allowed in that one. So I went with 40 in that one. And then I used geared A200, which is just an Aussie index fund that's geared a bit, which is, I think it's G200 is the code. And then GNDQ, like you have, Hayden, which is geared NASDAQ. And I think those were 25% each, which takes me up to 90% geared ETFs. And then to make up the remainder, I found another one, which was effectively a geared Aussie equal weight ETF, which is basically a basket of, I think it's around 70 Aussie companies, and they're more or less equal weighted. So it's like 1.5% in each company. And I think they might apply some quality filters and things like that. So it's not a perfect index fund, but it is not too far away and it's not concentrated on big companies. So because it's equal weight, it kind of skews more towards medium and a bit smaller companies than a typical index fund would. But I just filled that up with the Aussie portion of the fund. So when I combine it all together, I get a 98% geared super fund because I have to leave a little bit for cash. And then it's effectively, when you analyze the breakdown inside those things, it basically works out almost exactly 50-50 split between like global / US and Aussie shares, which I'm pretty happy with that.
The main question I have for you is that you said if you could. So the reason there are limits on certain ETFs is because I believe the trustee enforces them based on their decisions about risk. But I'm interested that you're like, I kind of wish I could have 100% GHHF, leverage DHHF, because in other episodes we've talked about portfolios and you don't sound like you invest in DHHF outside of super. It sounds like, you're a big kind of VAS, VGS kind of control the two parts. So I guess it's like, why do you have this desire for an all-in-one approach a little bit more in the super fund?
Because that's the closest way I can get to a nicely balanced, diversified portfolio in the simplest way possible, because there's no geared global shares. There's only geared NASDAQ. Right?
So if there was a geared VGS, like a G VGS or something, which they wouldn't call it VGS, but would you do that and geared A200?
All right. So there's now one from Beta Shares, which basically is a replica of VGS. That's a geared version, but Pearl doesn't have it, mate. So I think you need to pull your finger out and add that one to the list because it's not on there. Because if you did have that, then I might look at that instead. But because that would be slightly cheaper fee, I would say, than geared GHHF. But from memory, the fee on GHHF was actually fairly attractive, given those all-in-one funds tend to be more expensive.
Yeah. My next question for you would be, let's imagine that Pearl releases the GGBL, the geared global one, the VGS equivalent. Would you sell out your GHHF, or would you just be like, that's just, I don't like to sell, I'll hold that and I'll just put all my new stuff in these different layouts?
I would keep it.
ETFs.
Yeah, I would 100% keep it because it defeats the point of putting it in an individually taxed account in the first place if I'm having to pay the tax on it.
But do you think it's fair to say that it's not that you should be dogmatic to never sell? It's that there's no point selling because it's broadly aligned with your strategy anyway. Like if you came along, right, and for just some reason you were like, you know what? Global stuff sucks. I just only trust Australia. You probably would sell the GHHF, right? Because you're like, your portfolio doesn't reflect where you think the world's going.
Yeah, if I expected it to be a fairly different outcome that would warrant or justify the tax bill, which would admittedly be pretty small at this stage because I've only had it for a few months, then yeah, I would be open to selling. So it's not idealistically against selling. It's that there would just be nothing so similar, then it just wouldn't make sense because it's so similar and I can simply allocate new funds to that instead, or to a different fund instead.
And because GHHF is so similar to the combination of GA200 and GVGS or whatever the codes are, you're kind of like taking the 15% tax hit, reducing my principal by 15%. It's so unlikely that I would make up that tax effect basically because it's just so similar to the other stuff. It's not going to grow like way quicker if I split it up between these other two ETFs. So therefore it's just silly not to leave it alone.
Yeah, that's true.
That makes sense.
And I just confirmed the fees, and the fees are actually the same on the geared global from Beta Shares, GGBL, and the GHHF, the all-in-one fund. So that's kind of unusual compared to their normal funds where almost all the time an all-in-one fund is going to be more expensive than a single index ETF. But in this case, they're the same. So it actually makes GHHF more attractive and more affordable than it otherwise normally would be.
Yeah, sure. Okay.
So do you have any plans to, I mean, you did kind of speak about your portfolio in a way that implied that it's not a permanent state of affairs, that you may look at tweaking some things going forward, or are you just happy with your new plan of adding some geared funds and then leaving what you have already, or are you potentially
I'd probably leave it alone. I think there's a part of me that thinks, the effective gearing over multi-decades is going to be like better than avoiding the tax hit on the non-geared stuff. But I think the other part of me, Dave, is like, I just also feel like this space is also evolving a lot. Like, suddenly Vanguard might announce a geared ETF with half the fees in a year and a half. And like, it does feel a little bit like I don't need to optimize it all the time because it'll probably be imperfect most of the time it's in the super fund because things keep changing. But I would say that if there was a flash crash because I think right now I'm looking at it, my IVV's up 9% and my VAS is up 4%. If there was a flash crash where I could, because right now if I sold them out, I would be roughly having to pay, not a lot to be fair, but probably a few $1,000s in tax, which is not that dramatic in the grand scheme of things. But it feels icky because I'm like, why would I just make that money evaporate, I can pull some levers. But no, I think if there was a flash crash, like the AI bubble popped and that caused the market to decline 9%, which is very feasible that it could, and VAS, the Australian economy is pulled down by the US economy, then I think if it went back to zero or negative, I'd be like, might as well sell it out and buy some geared stuff instead. Probably. I've done that before. And I think it's good advice if you kind of if your portfolio is not up a crazy amount, like if it's up less than 30% and you kind of want to change stuff, it can be beneficial sometimes to just wait till it gets down to zero. But it's worth me disclaiming, of course, that you don't have to hyperfixate on tax, because that makes sense in theory if two things go down the same, because obviously it doesn't make sense if you want to go from investment A to investment B and investment A crashes. So then you're like, great, I don't have to pay any tax. And then you sell it and you buy investment B when investment B hasn't crashed, because now you basically just bought in at a higher cost base. So I just want to
selling low and buying high.
Selling low and buying high to avoid paying tax is a weird thing.
Rinse and repeat and you'll be rich.
Yeah, of course. So you don't overthink it too much. But I would probably change it if there was a flash crash and it didn't seem like I was buying high, selling low. And that would make sense, because if I was trying to invest in geared stuff and there was a flash crash, I imagine the geared stuff is going to suffer pretty badly in the short term. Even right now, all my geared stuff is down red. So
it definitely would.
It'll just get lower.
For anyone who hasn't really read about geared ETFs, or they've heard people say that they're kind of, slightly insane or something like that, or it's a recipe for disaster, please go and read my article, because it's a lot more well thought out than it might seem like on this podcast. And I'm actually going to do a follow-up article on it, because there was a lot of questions afterwards around how they work and what about this and what about that. So I'm going to do a follow-up that's going to kind of clear up all the other concerns that were raised.
Yeah, and go check out that episode 38 as well, because Dave unpacked a lot of that there, and a lot of topics in this podcast him and I are pretty evenly weighted in, but there's been a few where he knows a lot and he has wasted a lot of his life reading, and geared ETFs was one of them. And even the difference between different kind of geared ETFs was something that I think made me be like, okay, maybe these newer ones are worth it. So check out that episode and keep an eye out for anything Dave publishes, I guess.
Yeah, we might try and put that link in the show notes, because I'm sure there's a few people that's listening that's probably like, I don't know, that sounds a bit a bit funny. Sure. But in terms of overall super, do you add to your super, do you max out your super each year?
No, I've stopped doing that. I did that for a while, and I kind of...
Why? Why have you stopped? You're a tax saving fanatic. You're our resident tax nerd on the podcast and trying to reduce your tax, mate. What's going on? Why the change of heart?
Well, I think I said this in another episode when I was asked this question. It's I think there's a chance that just based on my ongoing contributions and compound, that my super fund will be at least 50% the size I would like it to be one day. Therefore, I'm kind of hesitant to lock the money away, basically. And my conclusion with it was I think contributing into super is a great idea for anyone if you are just so certain you're going to be short anyway. Because I think the way to think about it is broadly speaking, if you don't need the cash flow, I think it's better if you can put money in concessionally now. That's better than getting older and then having to put money in non-concessionally in large chunks to make up for it at the last minute. So it's if you're pretty sure you're going to have to dump more money into super one day anyway, you might as well start putting it in now, because it's a great deduction. And you get the compounding effect and everything else. But I think having done that for a number of years, I kind of just look at the balance and I'm I don't suddenly feel 100% sure that I'm going to have to put a lot more money in. I feel kind of just pretty sure. And that doesn't feel as strong enough for me to put money in right now, if that makes sense.
So when you think about that and you think about the future balance that you expect to be able to reach or hope to be able to reach, is that based on anything other than your personal life? Is that based on where you think certain super size balances will be taxed differently in the future or anything like that?
No, it's mostly just like compound interest calculator, what expenses would I need in the worst case kind of thing. I kind of have this attitude of like, if life goes really well and you stumble into really good jobs and professionally things work out or economically things work out, then you're probably not going to be like, damn it, I didn't put money in concessionally when I was 25 years old. You're just going to be like, life is good. So I mostly try and plan for the scenario of like, what happens if, what is like the most plausible downside case of how things plan out financially? And then it's like, okay, well, how much money would I want in super in that case? And how's it looking and tracking? So it's pretty rudimentary stuff. But, I started putting money in concessionally when I was like 25, and I had a super balance of like 30 grand or something. So it's a no-brainer. If you're 25 with 30 grand in super and you're earning good money and you're going to get a tax deduction, you might as well, get that money in early, is my view at least. But yeah, I don't overthink the tax policy stuff. I mean, we even saw this, like Labor had their unrealized gains tax policy, and then it got changed to something that everyone seemed more happy with. And it's hard. Like, it's hard to remember sometimes that bad policies often don't make it into implementation too. Like, I'm in various circles, Dave, that are like very progressive and very conservative, and like I've been to certain work dinners in rooms full of men in suits where like all they're doing on stage all night, like the MC is just bagging out Albo, demeaningly in a way, like silly labor leader doing silly policies, and you forget that, whenever there's a policy and maybe you get worried about it, that it has a good way of getting shaken up between all sides of the world to something a little more digestible. We've got to pass the Senate or whatever they say, right? So, and even if it passes, the next government comes in and changes crap anyway, right? They can just do that. They can just unwind things. So, I generally think it's all going to be pretty simple. And from what I understood about the last super policy version I saw, I was like, it doesn't seem absurd. So no, I try not to overthink that stuff at the moment. And maybe that's just a form of self-protection, because it feels like a race to the bottom as well, is constantly being like, oh, what's the government going to do with super and stuff?
Yeah, I try not to worry about or think too much about uncontrollables like that either. Like, obviously you can try and be aware of them and try and make your own predictions, but because of the sheer uncertainty with life and the future, you can't really make 35-year plans based on something that may or may not come true. I guess you've always got to work on probabilities and things like that. So it sounds to me like you're more what would you call it? Maybe the risk reward or the preferences trade-off has changed for you over time, where you now see your super balance getting to somewhere pretty decent over time, even if you don't add more to it. So now you're like, I prefer to keep some of this cash and use it outside super right now. Is that pretty much how you're thinking about it?
Yeah, I mean, no one wants to put money into super that they're going to regret putting in.
So you think there's a chance you may regret putting more in if you were to do that for the next 5 or 10 years?
I think there's a chance of it. I think it's slim. I think it's definitely like 10 or 20%. But it was easy to put money in when I was like, there's a 0% chance I'm going to regret this.
And do you think that's possibly because you're interested in buying a house potentially in the next 5 years or so? Is that part of that sort of thinking?
Yeah, I think all of that plays into it for sure. I think when you're younger and you don't have any kind of capital or anything like that, like even recently I've been trying to dabble around to figure out if I should refinance a loan and extend the size of the loan to do more debt recycling. And then I'm like, if I extend it that big, I don't even have the cash sitting around to pay off that little extra loan. And I'm like, it would be nice if I had that cash sitting around,
Yeah.
So there's always chances. Yeah, and at the end of the day, like no one's out there sipping, mango smoothies on the beach being like, thank goodness I made those concessional contributions in 2004. That's not a thing. So, I mean, it's the whole thing, right? We've talked about this on the podcast before. It's like negative energy stronger than positive energy, right? We hate losing $5 more than we like gaining $5. So I think sometimes it is a form of self-protection of like, well, if I think there's a chance I might experience some negative energy doing this, as opposed to no chance realistically, then maybe I just won't do it. Even though the chance of positive energy is higher, I'm not going to miss what never was. Whereas like if I actively do something and it causes me some grief, that'll make me sad. But to be clear, I don't actually think about this a lot, to be perfectly honest. I've been, two things. One, I've been very, very busy the last couple of years. So like overthinking super contributions isn't that high. But also because of the Australian government's carry forward rules with unused concessional contributions, it kind of doesn't matter too much because I think I was maxing out my concessional contributions all the way through 2021 or 2 anyway. So it's like technically I could throw some stuff in some unused caps in a couple of years anyway with the money I've got in anyhow. So it's not exactly the same, of course, because of how to bring down your marginal tax rate, and at some point the benefit might be less. But it's not like it's a lost cause. I think that's an important thing to flag to people too, is if you haven't put money into super last year and you feel like you've missed out on stuff, it's like you probably haven't because of how you can, carry forward those unused contributions. And it's definitely a worthwhile thing to look at, because in many cases, especially if you have huge amounts of cash, and especially if you want to put a lot of money into super, you're talking about like thousands, in some cases tens of thousands of dollars back on your tax return, if you think that's the right place to put it.
That's a very interesting segue, mate, because that's exactly what I'm going to be doing in the next, say, 6 months or so. With the proceeds from the sale of a rental property, we're going to be doing the...
I was about to ask, like, you don't even have an income because you're financially independent, but it's because of the sale and the tax you're going to have to pay.
Yeah. So I haven't had a job where I've earned any super for, 8 years now. So I have 5 years worth of unused cap space, essentially. So effectively that means I'm able to add $130,000 into super and claim a deduction. And so... at the point that we're at now, we can afford to do that without it affecting our financial independence. Like our assets outside super are enough to the point where we could add 100 grand or 200 grand into super. That is technically what would be called like surplus wealth for the purposes of financial independence. So that starts to make more sense. I would much prefer to have access and optionality over the money, but with selling a property, the capital gains owing is like not negligible. So by doing this, even though it's going to trigger that Div 293 rule, where you go over, was it 250 grand or something like that? Because they calculate so like my what would you call it? My writing income, and then my investment income, and then my capital gain on top of that. And then they also add on whatever amount you're adding to super. And then they calculate whether you owe this tax based on that. So I will actually have to pay that tax. So the super contribution won't be as efficient as if I was just putting in, a smaller amount under a normal year. But it is still worth it. I think it's still going to save something like $18,000-ish. Something like that. So it's fairly decent. And I decided that that was worth it. That was worth it for the next 24 years to put this chunk of money there, because we're going to be selling another property and we can invest that elsewhere.
I'll just reiterate to people again, because I think it's an easy thing to forget, and that's why I love this deduction so much. Like the super deduction's crazy. The fact that Dave can basically take a chunk of money and just shift it to his old self, nearly dollar for dollar, obviously gets taxed to 15% as it enters super. And then suddenly the government's just like, here you go. Here's a bunch of cash, to you shifting most of your money to a later date, whilst it quietly compounds effectively too, right? So I think that's great that you're able to utilize that, Dave, for your own benefit.
Yeah, I think it makes sense. And on an ongoing basis, I may also start adding to super just, normally up to maybe 30 grand if I have spare cash sitting around, because we are in that fortunate position where it is like essentially surplus income that we can, put in different places. So although the control and access and optionality is preferable, it does start to make sense at some point as our investments start to, grow and gain more traction, and the tax rate starts to get up there a bit. But I would be very curious to know if you're mapping out your future super, at least casually and very roughly in your mind, do you envision yourself at 60 turning on that income stream, or do you envision yourself sort of using the lump sum to maybe pay off some debt, like debt on a house or something like that, or you just haven't thought about it whatsoever?
Haven't thought about it whatsoever. Yeah.
Give me an answer right now.
What I do with the super money? You got to
pick one. Yes, pick one.
Try and live off it passively.
Okay.
Yeah.
What if you had debt still? You would keep the debt?
I'm going to assume if I was older, I'd be sick of the debt, even though right now I'm not scared of it.
Okay. Interesting.
We'll see.
So maybe lump sum then.
Yeah, maybe. Never thought about it. I think it's a great question, though. I mean, it's good to think about what you do in the future. So let me rain check you on that one.
We'll revisit that in episode number 17,000.
Yeah. So that's pretty much it for us today. I think we've covered everything we need to. We've talked about Dave's super portfolio, my super portfolio, how it's changed over time, and how we think it might change over time in the future. We also did talk a little bit about the choice of super funds, and in particular, the interesting effects of pooled and non-pooled funds. Not that we universally think one of them is, better than the other, but they have different effects, which depending on who you are and how you use your super fund and what you want to invest in, it may be, very interesting for you to consider if that's the right one for you. But it has been really fun talking about super. It's a big topic because it's where a lot of people's money ends up. And, for many Australians, it's actually probably the largest place they are investing, realistically too, especially if they're cash strapped and they're not able to, if you're not saving 10% of your take home pay, you're putting more money into super than you are everything else you're putting aside, right? So it's something that we think people should be engaged on generally as much as they can. But if you do have any questions you'd like to ask us about the episode, you can always email us at hello@aussiefirepod.com, or you can reach out to us on socials at Dave, Strong Money Australia, or myself at Perla. If you do have any particular questions you'd like us to cover on the pod, there is a link in the show notes to ask those questions. And if you would like to offer your own circumstance and potentially join us on the pod as a guest, as you've seen in the last episode, then you can also follow the link in the show notes to potentially be part of one of our case study episodes. But otherwise, thank you so much for listening, and we'll catch you in the next one.
Cheers, guys. See you next time.
We hope you enjoyed this episode of Aussie Fire. For more FI inspiration, head to perla.com to browse our resources, calculators, and community insights. Perla is an authorised representative number 1281540 of Sandland Private Wealth Pty Ltd with AFSL number 337927. Knowledge is power, especially when investing. So always seek advice and/or check out the relevant disclosure document for any financial product, including the PDS and TMD before deciding. These are available from the product issuer's website. When you invest, your capital is at risk, and past performance is not a reliable indicator of future investment returns.